Let's start by understanding what diversification means. Diversification simply implies the spread of all your investments across different asset classes, different geographies, and even different industries or sectors. This helps you reduce the risk in your investment portfolio and also lets you combat all the market fluctuations that happens over time. Think of it like this. Imagine planting a garden by yourself. You wouldn't want to plant just one type of flowers, would you? Well, this is the same principle that applies to your investment portfolio. You wouldn't want to put all your money into a single stock or a single asset. With this, now let us take a look at the importance of diversification in a little more detail. The first benefit of diversification is reduced risk and increased returns. Like we understood, in a diversified portfolio, you invest across different asset classes and different types of stocks. Your overall risk of the portfolio is a little less, and your portfolio will be able to absorb all the market volatility and fluctuations that occurred because of economic downturns. Not just that, because every kind of an asset class or every kind of a stock has its own importance and its own potential and strengths, you will be able to generate potentially higher returns because of the strengths of each and every different asset class. Now, the next benefit that you get from diversification is that it minimizes your choice of investments. Let me help you with a simple example. In a diversified portfolio, when you make an individual investment on different asset class, there is not too much risk attached because there's a lot of different assets you're investing in. However, if you're investing in just a few stocks, let's say for example 5, then each and every stock you invest into becomes a major decision. And if that decision goes wrong, then your entire portfolio will be affected. Another benefit that you get from diversification is a good balanced portfolio. Now, this kind of a balanced portfolio can help you align your asset allocation with your investment goals and with your risk appetite. For example, someone who is younger right now can take more risk by investing more into asset classes like equity. However, if someone is older right now, they can decide to take less risk and invest into asset classes like debt. So overall, it helps you maintain a balanced portfolio that aligns with your own investment decisions. And finally, a diversified portfolio gives you access to new investment opportunities. Now, since you have a diversified portfolio, you don't mind investing into different asset classes, different geographies, or even different industries or sectors. And that is why, if you're presented with a new opportunity that can give you a higher return on investment with lower risk, you will be readily available to take that opportunity. Now with this, we have understood what are the benefits or advantages of a diversified portfolio. But the next question comes out is that, how do you even make a diversified portfolio? What are the different instruments available for that? Let us understand and let us take a look at all the different instruments that you can use to make this portfolio. Now, to achieve this, mutual funds present a variety of different options to invest in. For example, you have the three main kinds of mutual funds, which are equity funds, debt funds, and hybrid funds. Under equity funds, your investment amount is invested into equity instruments like stocks. And the most popular kind of equity funds are index funds, which invests directly into a fixed index like Nifty 50 or Sensex. Then you have debt fund. Under debt fund, your money is invested into debt securities like bonds. And here you have different kinds of debt funds depending on the type of bond. For example, you have a corporate debt fund that invests into bonds given by or issued by companies. And there are gilt funds where your money is invested into bonds or securities issued by the government. And finally, you have the hybrid funds, which invests both into equity and debt. So you get a diversified portfolio within the fund itself. So overall, as you can see, you can use variety of different options and create a diversified portfolio for yourself. Let me help you with an example for this. Now, meet Amandeep. Amandeep is a 25-year-old and he wants to create a diversified portfolio with rupees 10 lakh as his investment amount. Now he wants to do it just using mutual funds. So let's make a diversified portfolio for him. Now, because he's young, he wants to put 50% of his investment into equity funds. So I'll write equity here. And this he wants to divide further down. He wants to put 25% of this into an index fund, and he wants to put the remaining 25% into a flexi cap fund, so he gets the added advantage of investing in mid caps and small caps. Now with the remaining amount, he wants to invest 40% into debt funds. And here he primarily invests 30% of his amount into a gilt fund which invests in government securities, and the remaining 10% in corporate bonds. And finally, the remaining 10% is kept as cash by investing into liquid funds. Now, take a look at this portfolio. By investing into flexicap funds, Aman gets the added advantage of investing internationally. And by investing into the index, Aman gets the advantage of investing in all the different types of sectors that are involved in making an index. And of course, he has other different asset classes involved with debt, and he has a cash component in his portfolio as well in liquid funds. And this way, Aman now has created a diversified portfolio. And you too can similarly create a diversified portfolio using this methodology. However, please do remember that it takes a lot of time, patience, and effort to maintain this diversified portfolio. You will have to review your portfolio every single year and rebalance the portfolio according to your investment needs, goals, and your risk appetite. Also, please do remember, over-diversification is risky too. So remember to allocate your investments according to different kinds of your investment goals, and don't forget to use all the different kinds of mutual funds that are available in the market just for investors like you and me. Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.